Well, good morning, everyone. Welcome to sunny Leicester, the centre of the universe, as I know it. That's where I was born, and that's where we operate from. So, a very convenient location right in the middle of England. I started in 1987 when I was 21, so I've been in business 35 years. Started off cleaning cookers in my dad's garage and moved through various shops, went online in about 2005 and bought various warehouses. We've now got a huge site, 8-acre warehouse in the centre of England, in Leicester. I was always underfunded because I always wanted to do everything myself. I wanted a business with minimum human intervention, so I invested a lot in IT, in the back end systems. But I bought a new warehouse, this huge site we're in now, and it hampered me considerably. So I was always constrained by cash. I've sold some shops, about £800,000 about 2 years ago now. That gave me some extra cash and some credits that I was owed, and chucked that back in the business. The accountant said, no, probably keep it to yourself. But I ignored his advice, luckily, and put it into stock, and off we go. So it was like having a light in the touch paper. Once you've got some money in your business, the difference it makes is incredible. So I was always strapped for cash, and now we're not, which is a great feeling, a great position. And what we do, I don't know whether you all know what we do, but we sell domestic appliances. We focus on more on the premium sector. So we're not interested in a £20 Morphy Richards kettle that Amazon can deliver and throw over your gate. We're more interested in the £2,000 Samsung American fridge freezer, or the Rangemaster £2.5 range cooker, a Miele washing machine for £1,000, not your Beko £200 washing machine. We do sell them as well, by the way. We don't want to ostracise ourselves from that market, so we want to cover all the bases, all the options, especially in this tough climate. But we focus more heavily on the premium sector, which is where I grew my business from. That was what I was always wanted to sell, premium product. So we have our own logistics, which makes a hell of a difference. So we've got about 120 van drivers now, some 40 odd vans, over 40 vans now. Josh joined us in a year ago, didn't you, Josh? So I'd just like to welcome Josh.
Yeah, thanks, Mark. I joined in April 2021, really to help Mark drive the business. Prior to that, I was with FTSE listed Intertek, and before Intertek, I was actually with Inchcape as well. And was just really excited about the opportunity that Mark and the team here had to really grow the business and grow the market share. So joined in April, and as Mark said, we successfully listed in November last year.
Yeah, fireworks night, wasn't it, Josh?
It was indeed.
November the 5th. Bit of irony there. So yeah, thank you very much. So can you flick onto the next slide, please, Hannah? Thank you very much. So revenue last year up to the end of March 31st, was just over 80 million. So we hit what we'd forecast. That was a 44% growth on the previous year, which was a 78% growth on the year before that. So we hit the number that we were aiming for, which is a 9% EBITDA margin. That dropped through 7.2 million EBITDA profit. So that was very impressive. We've got over 40,000 items in stock, 40,000 boxes of products in stock. That's 3,500 SKUs which we stock. Over 50 brands, 200 plus employees now. And it's all driven around our next day delivery, free next day delivery, and that is 7 days a week. That is what we do. And that's given us this Trustpilot rating of 4.8 out of 5, which is market leading. Well, I mean, no one else has got that rating. We're very, very proud of that. Thanks, Hannah. So here you can look at the market. So it's a huge market, the MDA market. It's worth about 8 billion in total. Sorry, the 5.4 billion for the MDA, major domestic appliances or white goods, however you want to call it. Consumer electronics TV market is another 2.5 billion. So it's about 8 billion, the market in total. So we've got about a 1% market share of that, or did have at the 80 million at the end of March. We've been increasing that. So you can see there, end of FY22, that was the average through the year, 1.6% market share, but we actually, and 0.21% for TV. So you can just see the minute share we've got of an immense market. So there's huge runway there. Thanks, Hannah. Now, financial overview, I'll leave this to the expert, Josh.
Thanks, Mark. So what we've got here is the H1 and H2 split for the revenue. So the things that I'd draw your attention to is in H1 of the last financial year, FY22, where we did 38 million. We were up 78% versus the 21 million in the prior year. And in H2, we did 43 million, which was up about 23% from the 35 million in H2 of the prior year. So if you like, the comp is tougher in the first half of FY23 for us. And as mentioned in our release, we've seen a strong start to the year in the first couple of months, doing over 20% revenue growth. But as we'll come on to into trading and outlook, it is a tough market, despite us doing well. At the bottom there, EBITDA margin of 9%, as Mark mentioned, and an adjusted EBIT margin of 7.9%. So very little in terms of D&A because we're CapEx light, and that obviously results in a strong return on capital employed of 57% as well. So a real class leading return on capital employed from us there. And we had a good year from a cash perspective, which I'll come on to. Next slide, please, Hannah. So in terms of the P&L financials, particularly for those of you that are perhaps new to the story, so the change year on year has been very strong in terms of revenue. It was really well flagged by us at the IPO that we didn't think the 13.7% EBITDA margin that we achieved in FY21 was necessarily sustainable. There were certainly some one-offs in that COVID year that benefited a lot of e-commerce retailers. So, for example, in the gross margin, you see the gross margin was a little bit higher in FY21. That was driven by really strong product margins because we were able to be a bit more opportunistic with price when supply was so constrained. That's worked its way out of the system now. In addition to that, because the growth came really quite fast in FY21 to the business, we didn't have a huge supply of drivers. And as a result, we were sending out around 1.2, 1.3 drivers per vehicle, whereas in FY22, we're averaging more like 1.9 drivers per vehicle, which effectively is saying we have nearly 2 men on every single delivery that we do, which of course is much better for customer service and a lot more sustainable from a time management perspective as well. Moving on to advertising and marketing, we spent 5% of sales on advertising and marketing, which was bang in line with our guidance. In FY21, it was somewhat cheaper to advertise online for e-commerce players. There are rumours that some of the big players even turned off pay-per-click during the COVID period. So it was a lot cheaper for us. And we think that 5% on advertising and marketing is the spend levels that we'll be at going forward. On the overheads base, so 4.6% in the previous year, 5.8% now, and we're guiding to around 5.5 to 6.5% as our run rate on overheads. Of course, there's been a lot of change in the business over the last 12 months. Mark's really invested in the management team. So you've had myself joining as well as a number of other key hires that we'll come on to later. In addition to that, we have Mark taking a salary through the base now rather than dividends. So this is definitely a much more normalized level, 5.5 to 6.5% of overheads. And it's really this line in particular that is really different to our peers. So the overheads, excluding advertising and marketing, this is where we believe we are very efficient. So all in that resulted in a 9% EBITDA margin. And we've always said that we believe 8 to 10% EBITDA margin is sustainable for the business going forward. So around 8 to 10% sustainable going forward. Thanks, Hannah. Just a reiteration of what I explained here, just to really help you understand why the 13.7% was a bit of a one-off during the COVID year. So as mentioned, a slightly higher margin on the gross margin. To give you some insights on delivery costs, because I know everybody's quite focused on that. So our delivery costs year on year were up 5%, which was driven by the increase in the number of drivers, as we mentioned, and improved pay and so on. And that was offset by delivery density. So as the business grew 44%, we had better delivery density in areas which helped. If you're thinking about fuel, fuel for us was up 15%. So fuel cost per delivery was up 15% during the year, and that compares with the total delivery cost per item up 5%. So we believe that we controlled that reasonably well, given what's happening. And also worth mentioning that fuel costs is quite a small proportion of the overall gross margin. So the increased fuel costs that we're seeing at the moment, of course, we don't welcome them, but equally they're not extremely detrimental on the margin because it's not a huge proportion of our cost. And then the advertising I've already mentioned, and the overheads also mentioned. There's a bit of a rounding in the charts. The previous page was 120 bits, it's 110 just to make the chart work, but it's that kind of level. Next one, please, Hannah. Coming on to cash flow and balance sheet. So you can see here in FY21, Mark invested quite significantly in the inventory. So you can see inventory went up 7 million in FY21. We continued to grow this in FY22 with an additional 3 million investment into inventory. We closed inventory at just over 14 million versus 11 million in the prior year. But we were also able to improve our payables position, not to extreme levels. Our average payables days is in the 50s. So it's not very detrimental or anything like that to suppliers, but we just managed to have better conversations. The business had expanded significantly, and suppliers really recognised that and allowed us to increase those credit lines, which was great. So operating cash conversion of 119% versus the 34% in the previous year. CapEx is very light in the business. We're pretty well invested. We just spent 1% of sales on CapEx, which was for some leasehold improvements that Mark will come on to, as well as for some additional vehicles across the fleet, which we'll also talk about. And we overall improved working capital from 10% of sales down to 5% of sales. And we think 5% of sales or lower going forward is definitely a sustainable place for working capital. So you should see, on average, moving forward, operating cash conversion in the range of about 100%. There's no real reason why that shouldn't be the case. And I will now pass back to Mark for the next section.
Thanks, Josh. Yeah, guys. So there's 4, key pillars, key focuses for us to drive the business forward. Continue doing so. Because firstly, customer proposition. Secondly, brand awareness, operational capacity, and then financial performance. So they're the 4 key pillars that we see that we need to focus on. Hannah, thank you. So here, if you look at this chart, the centre of the universe is that ME, that's where we're based, Leicester. So Marks Electrical HQ. Everyone is under one roof there, by the way. So we've got all the IT team that develop the software, develop the website, and help run the whole total business. We've got the sales team here, the customer service here, Josh and myself are here, the accounts team, the logistics, so all the warehouses here as well. So it's very easy for us to manage. So we can literally walk around the warehouse, talk to all the staff, see what's going on, see any problems that might be occurring, and head them off before they become a bigger issue. So all the vehicles all leave here in the morning. And they all return back to base at night. So any reverse flow stock, any returns, all the recycling of the packaging, it all comes back here. So, and the old appliances as well that we collect and charge for. So it's almost like getting reverse flow, filling your lorries up on, for a return journey leg, in effect. You can see that we've introduced here, we've expanded our service offering. So the bottom left down there on the UK chart, Devon and Cornwall, we introduced that initially because when we floated November the 5th, we were delivering just from Newcastle down to Exeter, offering the free next day delivery 7 days a week. We then thought, you know what, let's try and move into Devon and Cornwall. We tried that doing the next day, a bit too long a day for our drivers. So even though we were just giving them a 3-day working week, but it was still not quite effective for us. So we're doing that on a 2-day run. So just go down there and stay overnight, and that's working really well. We didn't even advertise down there. So just passive sales that we achieved in the first week of doing so. We achieved to fill 4 vehicles straight away. So we thought, you know what, let's give it a try in the Glasgow and Edinburgh area as well. So consequently, we tried that because we're actually equidistant. It's 5 hours and 1 minute from Leicester to Penzance, and it's 4 hours and 59 minutes to Glasgow. So we're situated perfectly geographically, which is rather fortunate being as I live here. So we added those extra postcodes in, and that's been very successful as well. So it's really a great location for running the business. So we are going to stick to this one model. We're not going to have 25 satellite warehouses like most of our competition have, which are very, very costly to run. You have to have HGV trucks trunking stock between warehouse to warehouse. Very, very expensive, not particularly environmentally friendly, and it just adds huge on costs. Plus, also, you're in the hands of HGV drivers. When there's an HGV crisis, you're just paying a fortune to acquire those drivers, and you basically your business grinds to a halt if you haven't got those people. So we believe that a nice simple operating model, which is what we've got, so very overhead light, minimum human intervention, because we've got a very good IT team who built the software to make it very simple to run for very few people. So it's cut down on the back end office requirements. So next slide, please, Hannah. Thank you. So you can see there some the SKU development. Josh, do you want to just talk about the about the finance offerings? Is that particular?
Yeah, I'll go through both. Yeah, so just showing here on the left really that we're expanding SKUs over time. Obviously, as we've become more of a nationwide electrical retailer of choice for people, we need to be expanding our electrical categories and also some ancillary categories too there. So you see taps, that sounds unusual, but it's actually really Quooker boiling taps that have average selling prices of 1,000 to 1,200. So really premium items that it makes sense for us to deliver. We're not talking about going into the general bathrooms and plumbing market. We've also added air conditioning and we've added barbecues recently. You know, big, heavy items, difficult to deliver, works perfectly with our own fleet. So just showing that over time there, we are expanding our SKU categories, and you should see us do that going forward. On the right-hand side, our finance offering. So we had very low penetration this time last year. Around 3 to 4% mark of our total sales was on a form of credit. We've since added ClearPay and Klarna for buy now, pay later options. We've also changed our traditional Barclays finance to V12 retail finance. And we see quite a mixture across those categories. So for example, ClearPay and Klarna, their average order price is between £300 to £400 for a whole range of different items. And then V12, the average order value is about £1,500. So, you know, range cookers over 12 months, 24-month payment plans, a whole range of different offerings that we're now providing to the customers. We've been very careful. Obviously, there's a lot of press around BNPL at the moment. We've been extremely careful in selecting ClearPay and Klarna. Believe it or not, in my role as CFO, I get approached by a buy now, pay later solution probably once a week via a cold email from all sorts of buy now, pay later solutions I've never even heard of. And we were just very focused on making sure that we go with the market leaders, ClearPay and Klarna, who, you know, are in communications with the regulator, and we really think will be the first movers. We're also looking at integrating the Apple buy now, pay later solution when that comes live. And we know that this is what consumers are demanding. They want to have this flexibility and payment option. But as we say, 10% of our sales in March, and growing. We've seen some growth in that in the recent months as well. Next one, please, Hannah.
Yeah, so on here, thanks, Josh, for that one. Interesting, by the way, you probably a fact or a figure here that Currys penetration on finance for their revenues like between 20 and 30%. So we've got a bit of headroom there to push for, Josh, haven't we, on the BNPL? So there's you've got plenty of offerings, you know, with the consumer issues that we're all reading about in the press and the media at the moment. So looking here, you can see we've got 50 odd brand partners. They're just the leading ones that we deal with. You can see that Bosch are there at 11.7%. Samsung there at 10, Rangemaster, LG, Neff, some real Miele, AEG, the real key premium brands that we really go after. We don't put all our eggs in one basket. I learned that a few years ago with Hotpoint. When I was doing about a third of my business was with Hotpoint, and one Friday night they decided to withdraw $500,000 of my discount. We're only making 750 grand a year, so it was a real kick in the teeth, that one. So it sort of taught me a big lesson not to put all my eggs in one basket and to spread the risk amongst many brands. So it's been very useful, particularly through the pandemic. Well, one particular supplier might be struggling with semiconductor chips, so you've got someone you can pull a few more levers and increase the revenue with a different supplier. So it really makes a difference spreading your risk amongst many premium suppliers. Also, selling premium product in particular, you find you get less faults with these products. They're better packaged, so less damage, better instruction books, easier to install. There's a whole host of things. So we do like to focus on the premium sector, but we're not ostracizing ourselves, like I've said before, from the Beko. We still want to, sell the lower end entry level product. Looking on there, also on the chart at the top, you can see add-on services. So in that includes extended warranties and the removal of old packaging, the two-man deliveries we do, and installation services. So we don't rely on any of these things. So with the consumer spending, the squeeze at the moment, if someone comes along and buys a washing machine for £399, they don't need to go for installation. They don't need to go for an extended warranty. We don't rely on pushing these extra add-on services. We can just sell the washing machine. They can have it delivered free the following day, 7 days a week. And that is a real key part of this business, that we don't rely on extended warranty. And this is only, we just do it through a third party. It's not a captive like a lot of our peers have, where they might make a lot more margin, but it's fraught with danger because it's on your balance sheet. There's a potential risk. Ours is just we take a commission, so a 5-year guarantee for, let's say, £100, we get let's say a £20 commission for selling that warranty. So that's just a straight drop through to the bottom line. So we don't push extended warranties, albeit we do like selling them if someone wants to buy one, because it's an electronic transaction and it's free cash effectively. So thanks, Hannah. Looking here, you can see looks like a bit like a heartbeat, and in fact that was my heartbeat when I saw it last June, when it dropped down. Our Trustpilot rating dropped to almost to 4.6. It went to 4.7. We really are focused on this, and we look at every bad review. Josh gets a chart showing them exactly when it's dipping, so we can look immediately and see if we get any. We're monitoring the reviews that are poor, because generally speaking, you get a 5-star review or a 1-star one. So there's not many in between, but the 1-star ones, we really do look at them closely, as we do the other ones as well. But we did a TV campaign last June. It was about £380,000. So it was not help funded by any brand. It was just purely funded from our pocket. So it's very expensive, but we learned a big lesson there because we were flooded with orders. It was a great problem to have. We were short of vehicles, short of drivers, and we couldn't answer the phone quick enough. So our reviews dipped. So we learned a good lesson there. We've since recovered from that position, albeit the sales revenue was good, but it clearly causes a few issues. And we learned a lot. You can see we've had a nice steady rise again. So things are looking very good. We do really push hard looking at and maintaining those good reviews. And that's all driven and derived by having your own drivers. It's not third-party logistics. Everything we do, or virtually everything we deliver ourselves, apart the exception of a few DPD items where it might be filters or the odd vacuum cleaner, going to an area where we maybe don't go to, or it's not worth going with filters, for example, for a cook-up. But it's all about having your own drivers. It really is a key part of the business. Thanks, Hannah. So here you can see, when we're floated with Panmure Gordon, we were depicted as the UK's best kept secret. In effect, we still are. Only 6% have heard of us when we floated last year. Now it's up to, we've earth-shatteringly moved the needle to 7%. So our biggest market is actually in London, where we grew it from 3% to 4%. So it just shows the runway and the opportunity ahead of us, that there is so much more that we can do. And the market we're looking at is particularly the John Lewis market. You've got Currys with a huge market share of nearly 30%. The bottom right quartile of that pie chart at 27% is the Mamas and Papas stores. So the independents, a lot of which are, closed down when the fathers and mothers decide that they don't want to continue running. Perhaps the kids want to pursue a different career. So they probably sell the building and then retire and close the store. We've seen a lot of that happening. You've got John Lewis with a 15% market share. They're more interested in closing the stores and turning them into apartments or offices. So that's where we're looking at. You've obviously got AO, which is a very good business. We've grown enormously. And then Argos as well. So we're predominantly looking at the market of John Lewis, the ABC demographic. That's what we're chasing after. Thanks, Hannah. So here on activity now, Josh, when he joined as CFO, he's now become the guru of marketing. And we'll go through some of this now.
I'm not sure about that. I think from a performance perspective, so we've split it here between performance and brand building. Performance, the online marketing is now very much a numbers game. It's all about being present in the online auctions for pay-per-click on Google, and then making sure that you're also driving activity on your search engine optimization and your conversion rate optimization on the website as well. So we've invested quite heavily in here in the last 12 months. We've hired a new agency to help us across these areas, and we work with them extremely closely, reviewing numbers on a daily basis to understand which auctions we're in, how the auctions are performing, what it's costing us, and how that works. You get to certain spending levels and you get diminishing returns quite rapidly. So we're very, very careful about how much we actually spend on digital. It's really easy to spend a huge amount, but it doesn't necessarily mean that you will get the return on ad spend that you need. So we also focused on brand building. As Mark mentioned, we did our first ever Sky TV campaign in June last year. We also did some Sky in November and December, and we've started to do some work on Channel 4 and ITV and YouTube as well. We expect to expand more in this area in the next 12 months. So certainly want to push this a little bit harder. Again, need to be careful about where we spend the money and how we spend it, because TV advertising is expensive, but we will be selective and consistently do this across the year. In June, we've launched a new TV ad. It's showing on Sky TV at the moment. And what we're seeing that's very exciting is that the brands now want to work with us and help us co-fund some of those adverts, so that we can reach a wider audience and do a bigger campaign. And that's fantastic, because go back 24 months and there's no way Marks Electrical would have been able to ask one of the major leading household brands to actually support us in an advert. So that's a really exciting point. Social, we've not done a great deal in social media over the past 12 months. We do intend on pushing that a little bit more in the next 12 months. You don't go on Instagram and Facebook to pick your next washing machine necessarily. But that being said, it's really important to create that subconscious awareness for the customer, so that they've seen us active on their social media channels. And when they come to using Google to search for the next washing machine, they feel like they know us already and they're prepared to work with us. So hopefully that will move the needle on that in the next 12 months, and that will really contribute to improving that brand awareness from 7% that Mark took you through. Thanks, Hannah. Moving to growth in web traffic and returning customers. You've got web traffic growth shown here in the top left, so we grow that significantly over the past few halves. Our CRM database, we've also grown that steadily too. We don't send lots of spam emails. We're very restricted in terms of how frequently we actually send an email to customers. We only do it around once a week. We noticed that when we were doing it twice a week, we were actually seeing that the database declined faster than it grew. So we're very careful to not send too many emails to customers and really just just send them an email once a week, showing them the interesting offers and deals that we've currently got going on. We only actually started tracking the database accurately in September 21, which is why the chart starts at that point. So again, this is a new focus area for us, making sure that we're serving up the right content across email. You can see here our total order growth and our returning customer rate. So we've been quite good at maintaining a returning customer in the range of 25 to 26%. It dropped to 24% when we had that huge amount of growth. But we're doing quite well to maintain it. And the eagle-eyed of you here will look at the web traffic and look at the total orders and say, well, that looks like a drop in conversion. That is true. And that's just a function of the fact that we're doing more television, more display advertising, more YouTube, and it's very much top of funnel. So we're starting to get people onto the website who are having a quick look. Oh, I've not heard of Marks Electrical before, whilst they're watching TV, have a quick look, and then probably not come back to us, maybe for a few months when they actually need a product. So doing more prospective advertising is definitely going to impact your conversion rate. But equally, it's all about top of funnel and really trying to get more people looking at Marks Electrical. Thanks, Hannah.
Thanks, Josh. Yeah, so operational capacity here. So you can see here our driver installer team. March last year was at 78, and March this year we closed at 116. I think we've got about 120 approximately now. The fleet of vehicles was 24. We've almost doubled that now. December 2020, I ordered 28 brand new Mercedes trucks. The last 3 actually arrived last week. So that was a good move. I got them at a very good price, pre-price rises. Consequently, they've had numerous price rises Mercedes have. They're all Mercedes. Every one of our vehicles, they all come with a 3-year unlimited mileage warranty. But the boxes specially built, very lightweight boxes with big Delandia tail lifts on them, which help for the delivery of the unfriendly freight. So you're trying to get a big American fridge freezer off, you want to give your guys the right tools for the job. And having a good lorry is a real necessity. Warehouse space, we've increased that. We put a new mezzanine flooring. That cost us about 300k. June last year, we had that installed. So that increased the warehouse space. We've subsequently had a little bit more added as well. We've also increased the way we stack products in the warehouse. So it's really increased the warehouse space, which is great. When we moved in here 5 years ago, we had about £3.5 million worth of stock, and I wondered how I'd ever fill it. And now it's it's certainly getting full. But it's also, we've installed a 24/7 warehouse operation. So we didn't used to have that time of float. We were almost 24/7, but the weekend we had quite a broken sort of shift pattern. So we've changed that now. We've got the guys work 4 days on, 4 days off, the same as our van drivers do a 4-day on, 4-day off shift pattern. So effectively, our people are already working the 4-day week. The vast majority of them, and they absolutely love it. There was some who sort of didn't want to actually change to the 4-day on, 4-day off initially, but now they do it. It's a great shift pattern. So you end up working hard for the 4 days you're here, but then you effectively, with your days off as well, you only work 5 months of the year. So it's a great job, keeps your workforce motivated. They get very well paid as well. I mean, that's another point. We do already pay at the top of the pay scale. We have increased that throughout the year, as you have to do so. So we make sure that driver installers get very well paid and rewarded for good reviews. They get rewarded for installations, carrying products upstairs, American fridge freezers, carrying those into houses. Anything that's outside of the basic delivery, they get rewarded extra cash. So that incentivizes them and gives them the incentivization to actually carry out the job, rather than turning up and intake of breath. Oh, I didn't really want to do that. They actually are pleased to have these additional services for themselves to actually carry out. At the end of the day, it increases their hourly rate considerably. So that does make a difference. They all go through a training process, showing them how to install American fridge freezers. It's not just one simple brand. You've got Samsung, LG, Haier, Hisense, Fisher Paykel, Rangemaster, Bosch, Neff Siemens. It goes on forever. So they're all different. They've all got slightly different ways that they're installed, and it's a real key part of the business, understanding that now. Amazon can't just go in and steam straight into doing, understanding how you do all these deliveries. It's not an easy thing to do, especially with our transient workforce. Ours are a specialised team of people that understand the installation. And that's what it's all about, your vertically integrated logistics business, all part of our retail business as well, online retail business. So, we get a margin from the e-commerce and a margin from the delivery as well, the logistics. So put it together and it makes for a nice margin, which makes you very strong, control of your own destiny, which is what I've always been about. I don't like relying on anyone else, hence why the investment in software. So back-end software, your own logistics. We've got our own fuel tank, so when there's a fuel crisis, we've got enough supply for almost a month's worth of deliveries, which was great. So everyone all being on site. We also have our own mechanic here as well. So anyone knocks a wing mirror off, in fact, we've got 2 mechanics now, so that they can put a bumper back on, or straighten something out, fix a tail lift. So it really keeps all those vehicles on the road all the time, and it is a key part of the business. Thank you, Hannah. Here, that just shows our warehouse. Bottom right, you can see there that 6 months ago we were only stacking American fridge freezers 2 high. We now go 3 high, which sounds ridiculous, but at one time that was the insistence from the suppliers, the brands, and now they realise that it's actually you can go 3 high, which also gives you that ability to increase the amount you can get in your warehouse, which is great. So we reckon we can get out of this current facility circa 250 million, which is a great position to be in. We have got plans as well. We're in talk with other developers for in the midterm, short to midterm, for a possible move to a lot big facility, which is not far away from here, which is just shy of 600,000 square feet, which you could mezzanine as well, which would probably get you to a circa 800 million revenue. So that's the aim. That's what we want to do. Thank you, Hannah. So there, Josh, you want to talk to that one?
Yeah, I'll take this one. So what's key for us and our vertically integrated delivery model is to maximise the value on every van. As Mark mentioned, we are focused on the premium side of the sector. We do the full range of products across the sector, but we have a really strong skew towards premium goods. And this is really reflected in the chart that you can see here. So the grey bar is the average selling price, including VAT, of a typical cooking item or a typical dishwasher. And then the blue bar is our average selling price of that item over the last 12 months. So you can see in most categories, we are operating at the premium end. If you look at TV, for example, average price in the market for television, 466, based on the GfK data. And we're selling on average nearly double that. We also get reverse flow revenue. So we offer the customer the opportunity to take the packaging away. We bring that back to our site here. That's our recycling equipment that you can see, so that we can recycle the polythene, the plastic, the polystyrene. And we also can take away the used domestic appliances that you can see here and make sure that they're recycled properly. And we get paid by the customer for that. So it means that when the van is returning back to base, we are actually generating an income on the return leg too. Not mentioned on this slide, but worth noting as well that we do pay to offset all of our carbon. So all of the carbon from our delivery vehicles, as well as our site here at Boston Road, is all fully carbon offset. So from that perspective, we are carbon neutral as well. We'd like to move to electric vehicles in the future, but the capacity of heavy goods vehicles at the moment and medium goods vehicles it's not strong enough in terms of electric battery capacity. But we'll certainly be one of the companies that's first signed up once the capacity does actually get to a level that we can utilise it. Next one, please, Hannah.
Thanks, Josh. Yeah. So we're nearly there, guys. Sorry for not. Hopefully, we're not boring you too much. One of the things I didn't or failed to realise when you float your company on the stock market, when you become a PLC, is that the value and that is for recruitment and attracting high level staff, which has been fantastic. So you get people actually wanting to come and join you. When you're a private business, they're not quite so interested. You might be profitable, but there's not so much future. But we've got some fantastic key hires that have joined us. Josh was the first one, obviously the best one as well. And those are the ones with the stars there. You can see there's James there, head of operations. He came from DHL. He is in charge of running the warehouse. Michael came from Domino's Pizza. He's Josh's number 2. He's fantastic as well. Heather HR, she came from a Burt Snacks, which was fantastic. And then Mark Gregg also came from the big outfit, LG. So he's come from the other side of the fence. So it's great having the person that doing the buying for television. He came there predominantly to do the buying. So having a PLC outfit, it really, really makes a big difference for recruitment, which I completely underestimated and didn't see that, but it's a real added benefit. Thank you, Hannah. So here you can see Josh, thank you.
Yeah, just finishing this section, as Mark said, we're nearly done. The ones I'd point out on here that you haven't seen on the other slides is the average revenue per employee. So we aim to have an average revenue per employee in the range of about £500,000. Key metric for us. A lot of listed businesses can quickly escalate in terms of overheads and cost and number of people. And we think this is a really important metric to check that we are being as productive as we were before. And hitting around £500,000 per employee. Some of our competitors, if you looked at them, they would be in the range of £300,000 to £400,000 per employee. So we do believe that we've got a good productivity gap there as well. In the bottom left-hand side, we've announced a maiden dividend at a 20% payout ratio, with the 0.67p being the final 2/3 dividend that will be paid in August to those on the register in late July. Thanks, Hannah.
Thanks.
So current trading and outlook, just to give you some insights into what's going on in the market, because obviously everybody on this call, I'm sure, is really focused on the impact on the consumer. So some stats there for the MDA market. Feb, March and April down 5%, 6% and down 12% in April. That is a very material swing for the major domestic appliances market. It's quite a consistent and resilient market. As Mark mentioned, 80% of what we do is from distressed purchases, being predominantly major domestic appliances. And the market of MDA is generally quite resilient. You see those kind of swings in the televisions and the laptop markets, but to be down 12% in April as a market is quite a significant move. We were up over 20% in April, which we're obviously very happy with. But the way that we're looking at the year ahead, as you would expect us to, is just taking each month as it comes along, being very, very focused on the business, very focused on making sure that we're delivering great customer service, trying to grow that brand awareness, which we think is the real opportunity. So even with the market declining, there is still millions of pounds per day of business being done in major domestic appliances, and it's just really important that we get our brand out there and we really show the top quality service that we can deliver at a price that's completely comparable with our competitors. On the right hand side, so just to reiterate outlook, we're saying there's definitely strong competitive pressure, particularly across online advertising and across pricing. Strong revenue growth year to date. We're certainly hopeful that will continue, and we'll be pushing very hard to continue to drive that revenue growth. And again, we're focused on controlling the overheads and trying to achieve an EBITDA margin in the next 12 months. As I've said, our outlook is between 8 to 10%. We just delivered 9%, but we're really focused on making sure that we grow well, but we grow well profitably. We're not trying to gain market share at all costs. We want to make sure that we continue to have that profitability as a differentiator. Thanks, Hannah.
Thanks, Josh. Thanks, Hannah. Yeah, so just to wrap up and summarise, so, last year was a fantastic year, revenue growth of 44% to 80 million, with an EBITDA margin of 9%, market leading customer service and a huge runway ahead of us. We've got, a 1% share of a £8 billion market to go after. So it's a huge market. It might be in slight decline, but the amount of market share we've got is so small, there's a huge runway ahead. So thanks very much for listening. Hopefully you're not too bored, and we'd welcome any questions, please, now. Thank you very much indeed.
Thank you.
Thank you, gentlemen. We've had a number come in, so let me make a start. What proportion of your marketing budget are you spending on brand TV? You've covered that, but how likely is it to change in the future?
Shall I take that one, Mark?
Please, Josh.
Yeah, so we expect in the next 12 months that we've said we're going to spend about 5% of sales on marketing as a whole. Within that, around 30 to 40% I would expect to be on television and display-based marketing. As we move forward over the years, I expect that will probably increase because, as we mentioned, TV is quite expensive, and obviously as the business becomes bigger, you have more pound notes and you can actually get into TV quite a bit more. And as also mentioned, the return from Google in terms of PPC, it diminishes quite quickly. So I think as the business grows, you will expect us to spend a little bit more incrementally on Google as we're a little bit better known, but really putting more into that brand building ever more every year going forward.
Okay, thanks. Obviously you detailed there how you're going after the John Lewis part of the pie. How do you compete against AO, who are, one assumes, going after the same part of the pie in the higher end products?
Well, I mean, we're the only ones that can deliver free tomorrow. Everyone else charges more than us. We've got very complex tracking software which tracks whoever we want to track, so our prices are fully aligned with the market. So first of all, we're at the same price, and secondly, we don't charge for next day delivery. End of. It really is that simple. So we're cheaper. So across the living crisis, people are careful with the cash, not less frivolous. So they're going to actually hunt around for a better bargain, and we're cheaper, loads cheaper. That should be our strap line. At the end of the day, it might only be 40 quid, but if a washing machine's £400, that's 10% cheaper.
No, fair point.
Massive market. We've got a minute market share. That's what I always come back to. And we deliver free on our own trucks and do it tomorrow.
Okay, well, let's come on to the point there about, small market share and people are still going out there and buying white goods. Given the sharp slowdown in the market volume since February, are competitors staying rational in terms of pricing, or is there a sign of increased discounting and voucher activity to stimulate demand?
No, not particularly. The cost per click's gone up considerably. So as Josh was saying earlier, the cost for advertising online is more expensive. So we've definitely noticed an increase in that. But the actual selling prices, the suppliers, the brands don't want you trashing the price of their products just to get that sale. Ultimately, people have to make we're here to make a profit. We are not at all costs going after revenue and sacrificing margin. We're here to make a profit and a return for our investors. We could, drive the revenue up considerably by slashing a lot of prices and discounting stuff. But at the end of the day, we want to make some money so we can reinvest and get a return for our investors.
Okay. You are a member of a mutual buying group for independents. Is there a revenue level where they might not want you as a member, or when it might make sense to go direct, and when do you expect to reach that point?
Yeah, well, I mean, it's always under review. It has its benefits, a lot of benefits, and it also has a lot of negatives as well. There's a cost to be paid to that buying group. We're a big outfit, and it's always under review. But currently it's great. It works very well for us. All the accounting process is very, very simple, and they're very easy to deal with. So it is not a problem whatsoever. But we always review it, and we've got a very good relationship with them, and we want to continue and build with them.
Okay. Are you taking on some risk if more and more of your customers are buying products on finance?
Josh, you want to take that?
Yeah, no. So, I mean, as mentioned earlier, we were very careful when we were selecting the buy now, pay later partners. We're not taking on more risk because we pay through our gross margin and don't bring that on balance sheet. So it's not a captive finance offering. We don't have it on balance sheet. It's funded by the partners, and they charge us through the gross margin for that. So if you were to do it on your own balance sheet, you may have the risk, but then you might have a bit more in gross margin. So that's the offset.
Okay. You touched on both the level of your overheads and how you're very comfortable that you can maintain that. And we talked about the operating margin, which you talked about maintaining between 8 and 10% on a sustainable basis going forward. You know, how I suppose what drives your confidence in your ability to keep those numbers at those levels when your competitors struggle?
Well, I mean, Hannah, we could just stay here as we are. You know, we're growing, as Josh was saying already. We've already grown 20% in the first couple of months. So, you know, we've got the overhead base in place already. We don't need any more management. We've got all the lorries and trucks. We've actually got too many, which is a great position to be in, because we write them off over 3 years. So anything that's 4 years old is a free vehicle sat there. So we've got plenty of trucks. We've got the capacity to deliver, you know, over 500,000 excluding VAT per day. You know, if you do the sums there, you know, that's 160 odd million pounds we could do. You know, we're not saying we're going to get there yet. That's a little way off. But the overhead base is already in place. We've got virtually 2 drivers on every vehicle, which is great for the customer service, like Josh was saying earlier. And all we need to do is add additional drivers. So for every 30 drivers we put on, we might need 1 more person in customer service, and that would really be the difference, and maybe 1 more person in the warehouse on a shift. So the actual overhead increase would be quite minimal now, because we're based at this one site. That's what makes such a difference. We are not operating 25 other warehouses around the country, and we all know the cost of running those is a fortune. You get lazy people working in them who don't want to do a job. Josh and me were running around, tearing around the country, checking what they were all doing, and lo and behold, you'd have numerous problems in each one, or a problem in several of them. So we're going to maintain this single site, and that's what controls our overhead.
Okay, thank you. What's the outer limit of your category expansion?
Oh, Mars. Who knows? You know, anything we can make money out of that's a sensible add-on premium product. We're not chasing a Morphy Richards kettle, like I was saying earlier, at £20. Amazon are quite welcome to pursue that. We're looking for premium product. We've got a premium customer base, and that's what we're going to focus on. So, you know, we might go move into IT and premium IT and premium small domestic appliances, premium vacuums. You know, that's what we'll chase after, those extra incremental products as well. But, you know, we've got a massive market already for us just to get better at doing what we do. Just switch on a few more SKUs, stock a few more SKUs with the likes of, let's say, Bosch or Samsung or LG. You know, instead of stocking 75% of their range, let's go for 95% of the range. You know, and that's what's right in front of your nose. Why chase after other stuff that, you know, it's like looking over the fence thinking, oh, I could do that. I'll sell sheds or lawn mowers or garden furniture. I mean, you can, you know, you stick to what you're good at. That's what my dad told me. I've yet to find it, by the way.
I think the evidence will contradict that, Mark. I think then on a closing question then, you detailed in the presentation that you had up to the ability to reach 250 million of revenue in your existing facilities, and you're very much built around a one centre model. How much further can you push the business beyond that and maintain that one centre ethos?
Well, you know, AO grew to 1.6 billion. And if anyone listening on the call will remember Comet, so there was Comet and Currys. They were the gurus of the major domestic appliance industry, you know, and AO came along with a brilliant idea and carried it out very, very well, and took Comet out, you know, and yet Comet were the fantastic business in its day. But, you know, clearly people can come along and revolutionise what's occurring. You know, and if you want to have 300 stores around the country, or 25 satellite warehouses or more, you know, they're very costly to operate. And to me, it seems like common sense to have all your products under one roof from a central location and deliver out to an area that you can get to. We don't need to go to John O'Groats or the Outer Hebrides. We're not after that. You know, we're going to go to where people live, and we can get to 99% of the population of England tomorrow. So I think that's enough to go after.
Lovely. Well, thank you very much for your time. We look forward to hearing from you again in 6 months' time. And a reminder to everyone that you can also see the research that we published earlier this week on the website.
And our shares are very cheap at the moment.
A great note to end it on. Thank you both.
Thank you, Hannah. Thanks very much, everybody, for listening.